The trigger for this week's video blog was a series of posts in a UK online discussion group about the value of monitoring gross profit, the fees to drugs ratio in small animal practice, and the wisdom of reducing drug markups to compete with online and other pharmacies. Now, I'm not an accountant, but clearly there is a logic for a business in which the prime activity is buying or manufacturing goods for sale to require their financial accounts to identify the gross profit. That is the difference between gross income and the variable cost of the raw materials or the products they purchase to sell on. Veterinary practices, on the other hand, are not primarily in the business of selling products, but of delivering professional expertise, time and skill. The biggest cost for the majority of practices is the cost of the vets, the nurses and the other professionals delivering those services. And for the most part, those costs are fixed. Practices are, of course, also in the business of selling a wide range of professional products, and many others are utilised in the delivery of surgical, diagnostic and other procedures. Those costs, frequently identified as COGS, the cost of goods sold, are variable and may also include lab fees, referral services, clinical waste and so on in the financial accounts for many practices. So I'm not sure of the logic of specifically identifying gross profit in the financial accounts for vets. For the majority of practices, the cost of goods sold as a proportion of gross income is likely to be much smaller than, for example, the cost of the practice team, of clinicians, management and support staff. On the other hand, if your practice accounts do highlight a gross profit of, say, 75%, a recognition that the obverse, i.e. that the cost of goods sold is 25% of income, is really important and perhaps more significant from a management accounting point of view. Why? Because then we can compare that cost with the cost of the practice team members and business overheads, and also with the revenue generated by product sales, so that at least in theory we can calculate the separate profitability of delivering professional services and products. And that brings us to the question of fees to drugs ratio for practice income. It's currently quoted by many accountants and others as 70-30 or maybe 65-35. But to my knowledge, that hasn't changed much in the last 40 years. It's not difficult to monitor the value of products sold, but much more difficult to keep track of the retail value of consumables, of dressings, drugs and other products used in delivering professional services. It can be done, and I think it's well worth doing to ensure that selling products and services both make a healthy contribution to the overall profitability of the business. If I had a practice now, I would certainly seek to shift the revenue balance significantly from goods to services, not by trimming charges for products, not by reducing drug markups to compete with online and other pharmacies, and certainly not by seeking to reduce the value or volume of goods necessary to enhance the value of the professional services delivered by the practice, but by taking every appropriate step to grow the practice income from professional services. How? Well, that's a great topic for a future video blog. See you next time.